Nilesh, good morning. Pleasure having you here. Thanks very much. How would you rate the budget for stock markets, Nilesh, on a scale of 1 to 10?
I think, Prashant, this budget honestly does not have anything specific for the stock market, but I think there's a lot for the economy. And I think to that extent, it is positive for the economy and therefore positive for the stock market. I think when we went into this budget, Prashant, there were two sets of expectations which were there, both kind of in a way negative, that I think the foreign investors were more focused on what that fiscal deficit number would be. There were apprehensions whether the finance minister will stick to the path of fiscal consolidation. Had he not, that would have been a serious negative. On the other hand, for domestic investors, purely from a stock market perspective, what was important was that would there be tax on long-term capital gains. That has also not happened. So to that extent, two negatives not happening, and in fact both of them being positive, I think is very positive for the markets from a very short-term perspective. I clearly believe for the economy, the fact that there has been so much of focus on agriculture, on rural, I actually believe that there was a wheeled, measured stimulus in this budget, which I think is going to do some good to the economy, is going to cushion growth, and so to that extent, therefore, that will translate into earnings and therefore will benefit investors in the medium term. So I think on the whole, a balanced, responsible budget, which is neutral to positive for the stock market.
Will we see a rate cut by the RBI, you think, in the next, very imminent, near future?
I think there is now a very, very strong case for a rate cut. I think if we look at, the previous credit policy announcements, I think the governor has alluded in the past to saying, let us look at the path of fiscal consolidation. And clearly the finance minister has stuck to the path of fiscal consolidation. He is likely to be at a 3.5% fiscal deficit. Inflation is sobered down, it's moderate, it's within the acceptable or the targeted range. And I think there are other banks across the world, especially in emerging markets, which are taking measures to boost liquidity or lower interest rates. And therefore, I think there is a very, very strong case for, a rate cut by the RBI.
25 or 50, Nilesh?
My sense is it will be 25. I don't think they'll go the full hog and do 50. It's quite possible you could have a 25 in March and maybe a 25 in sometime in April. So it's going to be staggered. It's not going to be. I would be surprised if it's one shot. If it's one shot, great. Obviously, that means there's going to be then a longer pause. But I think otherwise, I think even 225 bips in intervals of maybe 30 to 45 days each, I think should be good enough.
Nilesh, I completely agree that the government has kept its promise to the market, and the global environment is uncertain. They couldn't have spent more. So they stuck to 3.5%, that's fine. But is it at the cost of potential growth? Because now what, right? 25 basis point cut from the RBI? What is it going to really do? Is it going to turn things around? I don't think so. It's at the margin it may help. And look at what has happened in the budget. Against a 20% increase in financial year 16 budget for capital outlay, this time it's a 4% increase. This is of course obviously because they wanted to stick within that 3.5% number, right? To fund the rural, social expenditure, etc., we've seen, tax increases, surcharge, cess coming in on India Inc. And again, that all of this, the big number is that 3.5. So if you tie yourself in that, then you've got to do all these other things. If you look ahead, what is going to really spur growth? What is going to lead to better capacity utilizations? One comes up with a bit of a blank.
Yeah, so I think, Prashant, that's a fantastic observation. I clearly believe that 3.5 is more a hygiene factor. It's a number to which I think it's very, very important to ensure that our macros are stable. Clearly, if you look at what, the chief economic advisor had to say in the economic survey, or if you really look at what the finance minister has said in the budget, that we are in a backdrop of a pretty hostile or a pretty weak global environment. And I think in that kind of an environment where India can really differentiate itself is by ensuring that we have a stable set of macros, and clearly that gets reflected with the path of fiscal consolidation and that 3.5%. So I think that 3.5% is very, very important purely from a very hygiene point of view. Coming to growth, it's not that there's going to be one single factor which is going to drive growth. I wouldn't attach too much importance to that number of capital outlay, because I think a lot in the investment space, in the physical infrastructure space, will happen outside the government of India's balance sheet. It could happen through PPPs, or if you look at the proposed bullet train project from Bombay to Ahmedabad, where you're going to see a multilateral agency or a Japanese agency fund that project of about 89,000 crores, where about 80 or 90% will come in through a line of credit from there, repayable over 50 years. So it's not necessarily that the government of India needs to cut out a check for every investment project that it kind of undertakes in the physical infrastructure space. There are other mechanisms which are going to play out to fund infrastructure growth. So to that extent, I don't think I would attach too much importance to this 4% hike or on the capital outlay side. So that's that. And I think clearly a lot of initiatives which have been undertaken over the 12 months, 18 months, I think will start playing out over the next 1 to 1.5 years. I think the investment cycle is likely to pick up. It's likely to get better. In terms of the other areas of growth, I think there are three factors which will drive, and I call it the MIS effect, which will play out over the next few quarters. First of all is going to be the monsoon. I think we need a normal monsoon for growth to kind of sustain itself. So that's one. Two is these small doses of rate cuts which the RBI has done so far, and which it could do over the next maybe couple of quarters. I think that itself will contribute to growth. And third is this whole package of various stimulus measures which have got announced yesterday in the budget, be it the focus on agri, focus on rural, the focus on affordable housing, the PLR factor for villages, which is basically power, LPG, and roads to all villages between 2018 and 2020, if those are the deadlines. I think a combination of all of these factors, I think, will drive growth, will sustain growth in that band of 7 to 7.75%, which I think is very good in the current environment.
So that is MIS, right? Monsoon, interest rates, and small stimulus.
The package of stimulus, yes.
Okay, that's a nice way to sort of put it all together. So what will you, okay, let me ask you, what is the feedback that you get from foreign investors per se? And the reason I ask you that is because so far, one kept hearing that people are making a positive differentiation as far as India is concerned, because that's where the growth is, right? But now, over the last couple of days, or actually last couple of weeks now, I've been starting to hear that they're making a negative kind of focus on India. The reason is there was so much expectation built in from the government. They were overweight the market. There was a fair bit of, hope that things will really turn, and it's not happening. There is fatigue setting in. And if you look at the last recent, say for example, 1 month performance of India versus emerging markets, India's actually lagged. It's done the worst. Now, of course, it's very short term, very short term to look at, to draw conclusions from. But that's how it starts. I just want your thoughts on that.
Yeah, sure. I think that's again a very interesting kind of point out there. But I think when we speak to some of the international institutional investors, a couple of things come out. I think first of all, I don't think there is any fatigue with India. I think the reality is that there is globally a risk of trade which is playing out right now. I think within that, India stood out for quality. Investors were overweight on India, and from a valuation point of view, the outperformance of Indian equities had made India relatively expensive versus some of the other emerging markets. So I think that is one, and that is basically triggering them to kind of somewhere pare down exposures to India. So that's one. The second aspect out there is, as I was mentioning at the beginning of our interaction, that there were expectations that it's going to be challenging for the finance minister to stick to the path of fiscal consolidation. He may not get to 3.5. There were even estimates saying he could end up being at 3.7 or 3.8 or 3.9. I think that was creating some kind of nervousness and anxiety among some of the institutional investors. So I probably think that the February phenomena that we've seen with Indian equity markets is primarily because of these two factors. And then, of course, on the domestic side, there were expectations that long-term capital gains might get taxed, or the definition of long-term might get changed from 1 year to 3 years. So if you really look at it, these have been the factors rather than fatigue, because I think it would be, from a timing point of view, just, a few days before the budget, I think to kind of have experience of fatigue would probably be not the right time to kind of an experience of fatigue. I mean, you've waited for so long. It surprises me that institutional investors would not want to wait for a few more days. But anyway, so I think these are some of the factors which have basically contributed to that. Our sense is that the risk of trade might still continue for a few weeks or for a few more months. I think probably at a correction of maybe 5 to 7% or maybe even close to 10%, you could actually see India's valuations become very attractive. And that's again where you would actually see the FII stop their selling or maybe come in and buy as they start seeing growth visibility a few quarters down the line because of some of the factors or the phenomena that I alluded to earlier. So my sense is this is a temporary phenomena. We are towards the fag end of this risk of trade. It's not that, of course, it comes to an end yesterday or today. It might persist for a few more days or a few more weeks. But I think after that, we should again get back into a market consolidation and a market uptrend mode.
So at about 6,300 or so, right, the market valuations become attractive.
I think, Prashant, below 7,000 itself, we'll have to get very stock specific. We'll have to look at individual sectors because different sectors will throw
only
up.
At about 6,300, 6,400, would at an aggregate level, would valuations become attractive? Yes.
Yes, I think at those kind of levels, we'd probably start trading at about 15 times trailing earnings. 15 times trailing earnings. So we're talking of valuations being towards the lower end of the P multiple cycle at a point of time where the earnings cycle has been the most tepid or the most sluggish, so to say. So going forward at those kind of levels, what you see in the marketplace is potential for earnings cycle to revive and potential for a P re-rating, which I think makes the classic benign scenario for investors with a 2 to 3 year horizon.
Thanks very much, Nilesh. It's a pleasure. Appreciate you joining in with that perspective. Thanks indeed.